All right, markets are mixed amid more uncertainty on that tariff front, but our next guest says there's a lot of positive momentum, and now is not the time to reduce risk. It's also not the time to be a contrarian. For more on where he's finding some opportunities right now, I'm joined by Matt Orton, the chief market strategist over at Raymond James Investment Management. This is a very interesting thesis. It's not at all uncommon for people to say momentum begets more momentum, especially to the upside. But what about all those valuation concerns? What about tariff concerns? What about the uncertainty and the wall of worry? Are we still going to climb it?
Hey, Dom, always great to join you. And I do think we're going to continue to climb the wall of worry. I actually think having a wall of worry is probably a good thing for the market to overcome and to have, because it means that there isn't just universal positive sentiment throughout the entire market. And I think when you look at where we are right now, we've got very positive fundamentals. There are known unknowns. We know that there's going to be tariffs. There's questions with respect to how they're going to be implemented. There's geopolitical concerns, but there's questions around how they might ultimately resolve. And I think we're going to figure a lot of that out as we move into 2025. But for the rest of this year, we're coming off of a good earnings season where expectations for 2025 remain positive. You've had really strong corporate profit margin, which makes me feel a little bit better about where we are with respect to valuations. And one of the things I tell our clients a lot when they ask about, isn't the market very expensive? The average stock is not expensive when you look historically. There's a number of names, the Mag 7 included, that have gotten pricey, but there's a lot of parts of the market that aren't, particularly when you look down market cap, those companies who are more exposed to the U.S. economy, small caps. That's an area of the market I like a lot because they're still very cheap relative to large caps, and you're seeing an inflection point with respect to earnings, and I think that will sustain them moving forward for the rest of this year and well into 2025.
All right, so that small cap story is also predicated on this idea that lower interest rates do matter. At the same time, we've got a cross current of a stronger U.S. dollar on a general basis with regard to some of the policies that we're talking about. All of these things make for a very mixed picture. And by the way, a strong dollar also means rougher profits for large multinationals. I'm trying to figure out where you exactly, beyond small caps, that you see some kind of opportunity there. Is it still going to be in many of those larger cap tech names?
You know, Dom, it all comes down to selectivity. So that's why moving forward, I think as we go into next year, it's going to be more important what you own. The rising tide isn't going to lift all boats. And that's why I think a lot of the divergences that we've seen this year, where financials are so dramatically outperforming, where only some of the Magnificent Seven and mega cap tech names are actually outperforming, those trends are going to continue because it's supported by the companies that can weather a lot of those headwinds really well into next year. So financials, for example, particularly banks and capital market companies, I think those look particularly attractive because they're less exposed to a lot of those themes. They're more exposed to cyclicality and the strength of the underlying economy here, and the fact that we're going to go through a deregulation phase where that's going to lead to more deal activity coming through, hitting the bottom lines, and a steeper yield curve certainly doesn't hurt. And across the board, higher quality companies have less debt maturity cliffs coming up, so you don't need to worry about the impact of interest rates on some of those companies as much as you would think. Even further down market cap, that's why I emphasize to clients, look for companies that have good free cash flow, growing free cash flow, profit margins, return on equity. All of that's going to help insulate you from some of the issues of rising rates, perhaps an increasing U.S. dollar. So there's ways that you can get around those themes by being very selective in the market, and I think that's going to be very critical moving into next year.